To this week's episode of Accounting 101. This week we've got a question from Judy in Warrandyte. She's asking, my small dog grooming business is quite successful, but I think I would like to start selling some pet care products like collars, leashes and treats to my clients. What things should I consider before I decide to go ahead? How will this affect my accounting records?
Well, Judy, some considerations you need to understand that selling pet care products will make the business both a service firm, such as through grooming, and a trading firm who's selling products to earn income. Also, the inventory or stock now needs to be considered. Issues to consider include
how to keep track of inventory purchased and sold, what price the inventory should be sold for. This relates to the markup, which is the difference between the cost price and selling price, how to determine inventory levels to know when to reorder stock, and how to be informed of fast and slow moving inventory items.
So, Judy, how the recording is impacted. It's affected by the inclusion of an inventory ledger account and a cost of sales inventory account. You need to use a perpetual inventory system which maintains detailed records of the cost of inventory purchased and sold.
So with the inventory ledger, purchases, sales returns or inventory gains are recorded as increases on the debit side of the ledger, whilst sales, purchases, purchase returns or inventory losses are recorded as decreases on the credit side of the ledger.
So recording purchase and inventory. When buying stock from a supplier with cash or by credit, inventory being the asset is debited as there is no increase in assets. Credit entry is either to cash at bank or accounts payable with purchase of cash on credit respectively.
When recording purchase returns, you credit the inventory account as it's a decrease in assets. You debit cash at bank to represent increase in asset if it was originally purchased with cash. If purchased on credit, you debit accounts payable as a reduction in the liability.
Now recording sales. You need two journal entries. Number one, entry to record the sale is a credit to income and debit the asset, either cash at bank or accounts receivable. Number two, entry to decrease inventory on the left-hand side and credit inventory, which is decreasing the asset, and debit to expense account to show the cost of the inventory.
When recording sales returns and allowances, you need one entry to record the return. So you debit to sales returns or allowances as an increase in income and credit to either cash at bank or accounts receivable as a decrease in an asset. The next entry you need is to increase stock on hand. So you debit inventory and credit to expense to remove the previous expense recorded when the inventory was purchased.
Physical stock take should be done to see if the ledger matches the actual stock on hand. Theft and waste are two factors that can cause discrepancies. Any losses of inventory after stock take needs to be recorded as debits. Any gains of inventory after stock taking are recorded as credits. The journal entry would include the inventory account, either inventory gain or inventory loss at the other account.
That's this week's episode of Accounting 101.